48 hours, Wednesday, December 10th, 2 p.m. Eastern. In exactly 48 hours, Jerome Powell will announce a decision that could ignite the biggest gold rally since 1980. And Jamie Dimon, the CEO of JP Chase, the largest bank in America, just went on record saying gold could hit $10,000 an ounce. Not in 20 years, not in some hypothetical scenario. He said it could easily go to $5,000 or $10,000 in environments like this. This environment, this moment, right now. I'm going to show you exactly why one of the most powerful bankers on earth is making that prediction, and why it might actually be conservative. But first, you need to understand the impossible trap the Federal Reserve is walking into on Wednesday. Quick disclaimer, I'm not a financial advisor. This isn't financial advice. I'm not affiliated with anyone mentioned in this video. This is educational analysis based on publicly available information. Do your own research before making any investment decisions. Now let me show you what's really happening. Section 1. The Fed's impossible choice. Right now, right this second, the Federal Reserve is facing one of the worst scenarios in its history. On one side, inflation. The latest data shows inflation still running around 2.8%. That's 40% above the Fed's 2% target. And it's been above target for over 4 years straight. The longest stretch of elevated inflation since the 1980s. On the other side, jobs. The November ADP report just came in. Private payrolls didn't grow. They shrank by 32,000 jobs. That's the first decline in years. Challenger, Gray, and Christmas reported 71,321 layoff announcements in November alone. That's one of the highest readings since 2008 and 2020, both crisis years. The unemployment picture is deteriorating faster than any time since the Great Financial Crisis. So Powell has to choose. Option A, cut rates to save jobs, but risk reigniting inflation that's already too high. Option B, hold rates steady to fight inflation, but watch the labor market crack. There is no good option. There is no clean exit. The Fed is trapped. And here's what gold does when the Fed is trapped. It explodes. Markets are currently pricing an 88% probability of a rate cut on Wednesday. That means traders believe Powell will choose to save jobs and accept higher inflation. If that happens, gold isn't just going to rally, it's going to rip. Section 2. The pattern that predicts everything. What I'm about to show you has happened exactly twice in modern financial history. Both times, gold didn't just go up, it went vertical. August 15th, 1971, Richard Nixon closes the gold window. The US dollar, for the first time since World War II, is backed by nothing but paper and promises. Most Americans didn't understand what just happened. They kept working, kept saving, kept trusting. But the smart money saw it instantly. Gold was $35 an ounce in 1971. By 1974, $195. By 1980, $850. That's a 2,300% gain in 9 years. And it didn't happen because people suddenly loved gold. It happened because they lost faith in everything else. The dollar, the government, the system. When trust evaporates, gold becomes the only truth left. Fast forward to 2001. Gold is trading at $271 an ounce. Nobody wants it. Wall Street calls it a barbarous relic. Tech stocks are the future. Alan Greenspan cuts rates from 6.5% to 1%. Money floods the system. Housing boom. Credit explosion. Everyone's getting rich. Until 2008 arrives. Lehman Brothers, gone. Bear Stearns, gone. AIG, bailed out. The entire global financial system nearly implodes. Gold from 2001 to 2011, $271 to $1,900. That's a 600% gain. When central banks print money to solve problems they created, when trust in the system fractures, when the endgame becomes obvious, gold doesn't just rise, it explodes. Section 3, why 2025 is different. Now here's what makes this moment potentially bigger than 1971 or 2008. This time, we have both triggers firing simultaneously. Gold is already at $4,112 per ounce, up roughly 60% this year. That's one of the best annual performances in over 4 decades. But look at what's happening beneath the surface. The labor market is cracking. ADP, minus 32,000 jobs in November. Challenger layoffs, 71,321 announced, among the highest since 2008. Year-to-date layoffs, over 1 million, up approximately 50% from last year. Recent surveys suggest 40% of companies laid off workers in 2025, with 60% planning potential cuts in 2026. This is not a healthy economy. This is an economy showing serious stress. And at the same time, inflation won't die. Core PCE is still running at 2.8%, up from 2.3% in April. Why? Tariffs, supply chain disruptions, energy costs, and more tariff measures potentially coming in 2026. Inflation isn't going away. It could be accelerating. So the Fed faces the nightmare scenario, rising unemployment and rising inflation. Economists call this stagflation. The last time we saw it was the 1970s, when gold went up 2,300%. Wednesday's FOMC meeting is expected to be one of the most divided in modern history. Some analysts predict at least 2 dissenting votes, possibly 3. The last time there were 3 dissents was around 1992. That's how broken the consensus is. And this division isn't a bug. It's a symptom of something much bigger breaking beneath the surface. 4. The 13-month signal. Now I need to show you something that explains why gold's rally is not just momentum, it's structural. Approximately 13 months ago, China's central bank started buying gold. And according to the latest data, they haven't stopped. Not for a single month. 13 consecutive months of purchases. The reserves now stand at approximately 74.12 million troy ounces, worth an estimated $300 billion or more at current prices. But China isn't alone. Turkey, Poland, India, Singapore. Central banks worldwide have been buying over 1,000 tons of gold annually. That's roughly double the 10-year average. This isn't investing. This is preparation. Preparation for what? The potential end of dollar dominance? Look at the U.S. national debt. As of December 3rd, 2025, $38.4 trillion. 1 year ago, approximately $36.2 trillion. That's $2.23 trillion added in just 12 months. The rate of increase, $6.12 billion per day, $255 million per hour, $70 to $43 every single second. The Congressional Budget Office projects $2 trillion deficits annually for the foreseeable future. Interest payments on the debt now exceed $1 trillion per year, more than we spend on Medicare or national defense. And here's the critical part. Foreign central banks are slowing their treasury purchases. They see what analysts at institutions like JP Morgan are warning about: potentially unsustainable debt levels, political dysfunction, endless money printing. When foreign central banks lose faith in U.S. treasuries, they need somewhere else to park reserves, somewhere safe, somewhere neutral, somewhere that doesn't depend on any single government's promises. That's gold. This isn't just a trend. This could be a structural realignment of the global monetary system, and it's happening right now in real time. 5. Jamie Dimon's warning. Now let's talk about what Jamie Dimon actually said. In October 2025, at Fortune's Most Powerful Women Summit, the CEO of JP Morgan Chase made a statement that sent shockwaves through the financial world. Remember, Dimon has historically been skeptical of gold. He's called himself not a gold buyer. He's noted it costs 4% to own it in storage and insurance. But here's what he said this time. This is one of the few times in my life it's semi-rational to have some gold in your portfolio. And then it could easily go to $5,000 or $10,000 in environments like this. Let that sink in. The CEO of the largest bank in America, a man who manages trillions of dollars, who has access to information most of us will never see, is saying $10,000 gold is possible. Not in some distant future, in this environment. And he's not alone. Goldman Sachs has raised their December 2026 gold price target to $4,900. Bank of America analysts expect gold and silver to strengthen through 2025 and into 2026. A recent Bank of America fund manager survey found that 43% of global fund managers now consider gold the most popular trade, surpassing even mega-cap tech stocks like Apple, Microsoft, and Nvidia. Ray Dalio, founder of the world's largest hedge fund, recently recommended investors allocate 15% of their portfolio to gold. Not 5%, 15%. He called gold a very excellent diversifier amid soaring government debt and eroding trust in fiat currencies. When the smartest money in the world is moving into gold at the same time, that's not a coincidence. That's a signal. 6. The technical setup. Now let's get tactical. Gold closed Friday around $4,210 per ounce. Key resistance sits around $4,164. If gold breaks through that level on Wednesday after the Fed announcement, the next target is approximately $4,280, near the all-time high set in October. And if it takes out that level, analysts suggest there's a clear path to $5,000. Because at that point, it's not just technical momentum, it's psychological. It's FOMO. It's institutions realizing they're underweight gold and scrambling to catch up. Here's something crucial that reportedly ended on December 1st, just days ago. The Federal Reserve ended quantitative tightening. For approximately 2 years, they've been shrinking their balance sheet, draining liquidity, fighting inflation. They stopped. And if they cut rates Wednesday, they're not just stopping the tightening, they're reversing course. More money, lower rates, easier conditions. Historical patterns suggest that every time this pivot has happened, gold has rallied, every single time. With $38.4 trillion in debt, with inflation still above target, with geopolitical uncertainty everywhere, With central banks shifting away from dollars and buying gold, the confluence is unprecedented. Market observers believe conditions are set for a potential rally, with Wednesday's rate cut serving as the catalyst. 7. The miners' multiplier. Now here's something almost nobody is talking about. Gold is up roughly 60% this year. You know what gold mining stocks are up? Approximately 125%, depending on the index. Here's why. The estimated all-in cost to mine gold, around $1,600 per ounce. Current gold price, $4,200. That's roughly a $2,600 profit margin per ounce. Record profit margins. Record cash flow. And unlike previous bull markets, these mining companies aren't wasting it. They're being disciplined, paying down debt, buying back shares, returning capital to shareholders. If gold reaches $5,000, these miners won't just go up another 20%. They could go parabolic. Analysts at firms like Morgan Stanley and Jefferies have reportedly recommended portfolio allocations to gold in the range of 10 to 20%. Jefferies' reported gold target, approximately $6,600 per ounce. From $4,200 to $6,600, that's roughly a 57% move in gold. And if miners follow with their typical 2x leverage to gold prices, we could be looking at triple-digit percentage returns. This is why smart money appears to be positioning now, before Wednesday, before the crowd realizes what's happening. Because once gold potentially breaks $5,000, there may be no going back. 8. The convergence. Let me summarize what's converging right now. December 8th, 2025. 48 hours before the Fed's decision. Gold at approximately $4,212. Jamie Dimon, CEO of JP Morgan, publicly stating $10,000 is possible in this environment. Goldman Sachs projecting $4,900 by end of 2026. China buying gold for 13 straight months, 74 million ounces and counting. Central banks globally accumulating over 1,000 tons annually. U.S. national debt at $38.4 trillion and climbing $6 billion per day. Interest payments on the debt exceeding $1 trillion annually. The Fed trapped between inflation and recession. One of the most divided FOMC meetings in 3 decades approaching. This is not just a prediction, this is pattern recognition. The 1970s showed us what happens when currency loses its anchor. The 2000s showed us what happens when central banks print without limit. And now we're watching both scenarios potentially play out simultaneously. Debt explosion, plus currency concerns, plus geopolitical uncertainty, plus central bank repositioning. That's not just a bull market in gold. That could be a monetary reset. 9. Wednesday's catalyst. Wednesday, December 10th, 2:00 p.m. Eastern, Powell announces. If he sounds dovish, if he signals more cuts are coming, if he prioritizes jobs over inflation, gold could rip higher immediately. If he sounds hawkish, if he tries to walk back expectations, gold might dip short term. But here's what I believe. Long term, it may not matter. The underlying drivers are locked in. The debt isn't going away. The central bank buying isn't stopping. The dollar's historical dominance is being challenged. Gold has been money for approximately 5,000 years. The US dollar, about 52 years since Nixon closed the gold window. Which do you trust more? 10. The choice. When gold was around $800 in 2022, critics said, overpriced. At $3,000 in 2024, they said, can't go higher. At $4,000 in 2025, they said, bubble. And now, at $4,200, many remain in denial. But the major institutions aren't in denial. Goldman isn't, China isn't, Jamie Dimon isn't. They see what's coming. And they're positioning accordingly. You have a choice. You can watch from the sidelines and hope it works out. Or you can understand the pattern and act accordingly. Because if Wednesday's Fed decision turns out to be the catalyst many analysts think it is, if gold really is heading toward $5,000 and beyond, this could be the moment you look back on. The $5,000 gold forecast isn't a dream. It could be a destination, and we may already be on the road. Hit subscribe right now. Turn on notifications. The next video breaks down exactly how Powell's announcement could move markets, which sectors could benefit most, and specific opportunities to watch over the next 12 months. Wednesday's announcement may just be the beginning. I'll see you in the next one.